Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, December 26th, and then we'll see how things look for Wednesday, December 27th. It looks like we might be having what's called the Santa Claus rally, which are the 5 last trading days of the year and the first 2 trading days of the next year. We don't know if that's going to continue. We have to take all of these days together, but that's one of the bigger signals to point to the next year being either positive or negative. And I'll go through that. That's based on some research that was conducted by the Stock Traders Almanac book. And as we get closer to that time, we'll have to see if things actually end up playing out that way. But we had another up day. We're still well overextended to the upside. We're looking more and more overbought with each up day that we have, but we're also seeing the small caps, which may be showing some January effect move going higher. We're seeing a little bit more strength in the mid caps, and we're also seeing the broad market start to participate more than the mega caps. So for right now, things are looking quite healthy. On the other hand, volume is really dropping off. We're in between Christmas and New Year's now. A lot of folks are on vacation. A lot of folks are just assuming that the market's going to go higher. We're in a positive seasonal time. We want to have some respect for the idea that if somebody comes in that's kind of a big player and starts to sell, that could really push things down quite quickly, like we saw last week. Not saying that's what will happen, but we just have to be prepared for that in case something like that does play out. So let's go back and talk about what happened. Right at the open, we had a higher open. The futures were up. I was tracking them over Christmas Day and then through the night. We were up, just not big time, anywhere from 0.1% to about 0.25% higher. But we were able to hold on to that and take that into the open. And then right after we did open, prices climbed up above R1 at 47.73. And that was pretty much the move for the day. We hit resistance up at 47.85. And then prices fell back a little bit below that resistance that we hit, and we closed slightly above R1. So we were up 0.42% on well below average volume. And we are positive, and I'll go through all the charts showing that we're really overextended to the upside, but this can go on. And in a positive environment, a market can stay overextended for quite some time. We just want to be aware that things are getting so extreme that is there a setup coming to see some kind of a more significant pullback? Maybe not this week. It might play out this week, but possibly after the beginning of the year. And because of this inflation and interest rate scenario that seems to be turning more market friendly, and of course, we're also keeping an eye on the different geopolitical events. We are in holiday mode now. Last week was pre-holiday mode. Now we're in holiday mode. And we're wondering, is the Santa Claus rally starting to happen? Is that going to continue? That's, as I said before, the last 5 trading days of 1 year and the first 2 trading days of the next year. And then so far, it looks like the January effect is still continuing. The NASDAQ 100 did hit a new all-time high. The Dow did not. It was up, but not to a new all-time high. The S&P is getting close to that all-time high. We're watching to see if we get up to that level. Is that going to produce some overhead resistance? Oil ended up rising on news that there was an oil tanker near India that was struck by an Iranian drone. So that kind of freaked out the oil markets a little bit. Here's our list in the short term for overbought or extreme positive indicators. We still have our ADX. That's been that way now for a few weeks. The advanced decline ratio, the 20-period exponential moving average, the Williams percent R, the Stochh RSI, it's kind of neutral right now. It's not really jetting higher like sometimes it does. We do have a new addition with the CCI 14 as well as the 20, which has been on the list. The stochastics chart, the RSI based on 9 periods, the boom indicator on 20 periods, and the PMO oscillator. And our intermediate term list just keeps getting longer, and really nothing is coming off of the list for right now. We have our regular ADX indicator, which measures the condition of the trend. That's really extreme. The 50-period exponential moving average study, the standard deviations chart, This is a new addition. The rate of change going back 50 periods, it had been extreme a while back, then it dropped off. Now it's back up to looking extreme again. The Arun indicator, and another new addition is the S&P 500 McClellan oscillator, starting to get extreme. The PMO studies that we look at, the Sean trend meter, the Chaikin money flow, the boom indicator based on 50 periods, the balance of power, the RSI based on 14 periods, the bullish percent index for both the S&P and the NASDAQ 100, our new high, new low study for the S&P 500, and the advanced decline ratio. For Tuesday's video, it was just based on price. Now we're seeing an extreme reading with the advanced decline ratio based on price and volume. Long term, we still have our moving averages based on 150 periods as well as 200 periods that are extreme positive. And we're still working through the same scenario, shifting from a more Fed hawkish stance to a possible more dovish stance for the Fed, that they might be now done raising interest rates. We'll have to see how all the economic reports play out. And even in the future, looking as soon as March of maybe even starting to cut rates. We'll see how that plays out. That changes every day. Right now, we're kind of in limbo since we're in holiday mode. We'll see if the market gets a little bit more conviction about that at the beginning of the year. The dollar was down, which helped to give support to stocks, as well as interest rates being down. And with the 10-year yield, we're at 3.89%. We still have the 10 to the 2 and the 10 to the 3-month yield curves, which remain inverted. And it's been that way for at least a year and a half for the 10 to the 3-month. It's been closer to 2 years almost for the 10 to the 2-year. Sentiment is back to looking extreme positive again. And this could also be another pretty big warning sign at some point. Now, we could go higher than this, but we're above 75, where we're at 79 right now. And that is when we're getting pretty extreme positive with our sentiment. Our trend is still positive, but it's looking really extreme positive. Our bias is positive and our momentum is positive. The economic reports that came out, it was not a real heavy day for these reports to be released. We had the FHFA Housing Price Index. It was up 0.3%. Last time it was up 0.7%. We had the Case-Shiller Home Price Index. It came in at 4.9%, a little bit less than the 5% they had expected. Last time it was at 3.9%. So to look at some charts, looking at the FHFA Housing Price Index, it continues to go up. And if this keeps going up, this has already put some pressure on people wanting to buy homes, because not only are interest rates going up, but housing prices are going up as well, and they're kind of getting priced out of the market. But for right now, we continue to see a higher trend with this index. And then looking at the home price index from the Case-Shiller folks, it's also going up as well, just showing that housing prices continue to go higher. Here's excuse me. Here's our intraday chart where we did have a higher open. We didn't really gap all that much, but we were positive right out of the gate. We saw buying coming in. We came up. We hit resistance along R1 for a little while, and then we're able to break above that. We went up to almost the 47.85 level before coming back down, going into the close. Intraday, we were fairly positive in the pre-market session with the futures looking okay, but kind of chopping around, not all that big of a move. We saw most of the positive action actually happen while the market was open, and we're pretty much unchanged to slightly higher in the initial overnight session. But when we look at growth of value, and this is one of our concerns that we've been watching for a while now, the red line is above the blue line. That means that growth is outperforming value. I'm sorry, that means value is outperforming growth. And when we look at our intraday chart for the S&P, we're also seeing where growth is underperforming value. This is another warning sign. And on an end of day basis, both growth and value were up for the large caps, but growth was up less. It underperformed. They were about even for the mid caps, and they underperformed for the small caps. And this is a concern also. This is another look at growth to value ratio on an end of day basis for the S&P, where we continue to, at best, go sideways right now. We're not necessarily declining. We're still in a longer term uptrend, but we're getting them down to the lower end of this range where we've been at before. We want to see this going up, and that's not happening. Is this leading to some kind of an idea that maybe after the first of the year, there's going to be more of a significant pullback. But when we look at some of our other growth of value charts and how the smart money is playing right now, those are still looking positive for the time being. But where we are seeing some more hope is when we look at mid-cap growth of value. It's actually breaking out of the range and quite positive and is closely following, at least a little closer, what the index has actually been doing. Keeping an eye on our trend, we're still very extreme with the ADX and it's above its moving average. The green line's on top. It's not extreme yet, but we would default to the positive, but be aware that the ADX is quite extreme right now. And in the short term, it's just about on top of its moving average, even though the green line continues to be on top. So in the short and intermediate term, we're looking pretty extreme with our trend indication study. We are seeing volume really dropping off as it goes into holiday mode. Keeping an eye on sentiment, we're wondering the VIX keeps falling for the most part, where we're coming into the latter part of December. But according to the average, sometimes we see a bump up in the VIX as we get closer to the end of the year. The Ulcer Index is suggesting that there's just not a lot of fear in the market. When we look at the VIX, we did decline on the line chart as well as the bar chart, and we're below the moving averages on both. The VIX of the VIX is also, it ticked up just a little bit. It's right in between the moving averages on the line chart. And you might have a little bit of hedging going on. Some folks might want to do that. So we didn't really see a big drop with the VIX of the VIX. This is another thing that we're keeping an eye on. And this is typically negative because we're not getting a lot of information right now from the VIX itself. It's giving us such low readings. We look at a correlation between the VIX and the S&P, and this is starting to go higher. We're not at this dashed line yet, but if we go above that, spike up and come down, and you look at other times when that happened, that quite often marks some kind of a top or at least a short-term top in the market. So we want to keep an eye on this chart. The equity put call ratio, it ticked up just a little bit on an up day. Again, possibly some more hedging going on. But when we look at the 5 period, it's back to going down. So that is longer term positive. We are seeing some improvement with our risk on to risk off ratio. It's continuing to go up and is more in an established uptrend now. That's positive. And we look at the advanced decline line based on price and volume. We're looking pretty healthy. We have broken out based on price. We're showing a little bit of a negative divergence. We haven't broken out above this previous high based on volume, something to be slightly aware of. And we did see an expansion of the new highs, even though that's not really helping our 5 period. It's flat and going sideways. We actually turned down just a little bit with our 10 period. When we look at our advanced decline ratio based on 19 periods, we're getting extreme positive. We're not quite there yet with the 39 period. That's the red line. Another up day, and we could possibly go extreme with both of these. The accumulation distribution is still looking positive, even though it's kind of far away from this moving average. We want to be aware of that. And the chicken money flow is positive, but looking pretty extreme. Other times when we had really high readings like this, sometimes that would mark a top in the market. The cumulative NYSE advanced decline line is showing some improvement and just barely breaking out above this previous high. When we look at our regular NYSE advanced decline line, that is showing some strength too, as we're seeing the broad market participate more than the big mega cap stocks. Here's our other NYSE advanced decline line, also breaking out above this previous level, and that is showing some improvement. When we look at common stock, this is where we're seeing just a tiny bit of a negative divergence. We're breaking out above this previous high based on price for NYSE common stock. We have not been able to break out above this range based on volume. And as I mentioned before, a few weeks back, we were seeing just the opposite of this, where volume was actually leading price. Now we're seeing price leading volume. Sometimes that can be a negative thing. When we look at our advanced decline line studies, though, we are showing a lot of improvement with all of the different indexes across the board. Looking at the daily chart, we have not been able to really surpass this previous high yet. We did get there intraday, but we closed down just a little bit below it. But for right now, the S&P is really looking fairly positive, and we're creeping ever closer back to that all-time high that we may get to at some point. But when you look on the bottom, you see where volume just continues to really drop off. But we are extreme with our 20, 50, and now even our 200 period exponential moving average study. The Williams percent R is extreme positive. Here's the CCI 14, which is strange. It actually was showing it being extreme positive. Maybe this one should not be on the list after all, but the 20 is above 100. So that is extreme positive. The force index, it's okay. It's positive, but it's below its midpoint and it didn't tick up all that much. But when we look at our stochastics, we are extreme in the short, intermediate, and long term. We're really extreme with our standard deviations chart. We still remain camped out in the +3 standard deviation channel. And our boom indicator is extreme with the 20 and the 50, and it's still looking positive with the 200. The balance of power ticked back up just slightly and continues to be extreme positive. When we look at trend based on the go, no-go system, we are still positive. And we're kind of flattening out just a little bit with our highest high value, but we're still above an advancing midpoint. The TTM squeeze is still looking positive with the lighter shade of blue bars. And the ease of movement is turning back up and is above 0. That's positive. Here's the rate of change going back 50 periods. We were here earlier on. We wore that off. Now we're starting to get extreme again. The Erin indicator is still giving a very high reading. That means the buyers are pretty much in total control now, as sellers are not really involved. And when you compare the two, the oscillator gives us an extreme positive reading. Here's the S&P McClellan oscillator just starting to get to an extreme positive reading. We're continuing to go up with the summation index based on price, and we're turning back up based on volume. I was pointing out that we were seeing this declining, and sometimes that leads us by a day or two. Well, now this is switched back to going positive again. We continue to advance with our NYSE summation index based on price and volume. We're starting to break out above this previous high with price. We're just coming back up to this level based on volume. So we're seeing price leading volume right now in a lot of different areas, and that can be a bit of a warning sign. When we look at our double and triple exponential moving average study, the red line is on top. That shows that the trend is stronger. And lately, as we've been putting in the low for the day, this has been providing support. With the Swenlin trading oscillator, we're above 0 and advancing based on price and volume. So that's positive. We're really extreme with the PMO. We've been extreme now for quite a while. We're looking extreme based on price. We're turning back up slightly and starting to get an extreme reading based on volume. With our PMO studies, we're not extreme with the PMOs that are rising. We're turning back up slightly with the buy signals, but where we're extreme is with the PMOs that are above 0. We continue to be neutral for the Elders Impulse system for the S&P. The parabolic SAR is still positive. The slope oscillator is back to being even more extreme, but continues to be positive. The MACD is still above its moving average and could be giving us an extreme positive reading. So when we look at all of our oscillators, the slope and TSI, these are the short-term oscillators. The TSI is pretty much on top of its moving average, where the MACD is slightly above its moving average and could be extreme positive. The same thing with the PMO and the PPO. They're both positive, but getting extreme. We're getting extreme with the TRIX, our long-term oscillator, and we're also extreme with the KST. But when you take all of these all by themselves, they're pretty much positive across the board. We're well above all of the plotted moving averages in our moving average tree as the moving averages are turning to go higher to catch up with price. And we're still extreme positive with the bullish percent index. We really haven't started to decline, at least yet. We're still positive with the NYSE bullish percent index and not extreme, but we're getting really extreme with the NASDAQ 100 bullish percent index. The Sean trend meter, it's not extreme, but it's still in extreme positive territory. Chaikin oscillator continues to decline, and it's just barely coming down. Another little decline here, and it would no longer be extreme positive. The money flow index actually declined a little bit, but it's still above 50. That's positive. The ultimate oscillator turned back up slightly and is above 50. That's positive. The vortex shows the green line going up. That is positive. The Copic curve is positive. We're getting extreme positive with our RSI studies based on 14 as well as 9 periods. On balance volume continues to be positive. We're getting really extreme with our 200 period moving average study. You can't go much higher than where we're at right now. And we're also very extreme with our 50 period moving average study. I don't have any Fibonacci or line studies because we're either above lines or above Fibonacci levels or we're still in no man's land. So we look at some other charts based on how we analyze the trend, where we're positive with the hike in ASHI, we're positive with the KEGI, we're positive with the Renko, and the 3-line break, which had been showing a little bit of negative action, has now switched back to looking more positive. Long term, we have our 150 and 200 period simple moving averages, which are extreme positive, and we're above this longer term trend line. If we fall, will that provide support? We've been above this before, only to give that back. We want to know, can we keep going higher as we get closer to this all-time high for the S&P? And we're getting a little bit above that now with the NASDAQ 100 right on this longer term trend line. The equal weight index is showing some real improvement, and for over the last few sessions has actually been outperforming the S&P, and we're seeing that when we look at this ratio going down slightly. That just means that the mega caps aren't really holding up all of the indexes right now. The Dow theory, this is another concern. We're not quite back to the all-time high with the Dow, but we haven't even come back to this previous high with the transports. We did see a little bit of a bounce with the utilities. And the transports continue to underperform the Dow. That's a negative divergence. The Dow was up on the day, but not back to its all-time high, at least yet. We continue to be neutral for the diamonds with the Elder's Impulse system. We are breaking out just a little bit with the NASDAQ. So this chart is still looking pretty healthy for right now. And the NASDAQ 100 is also going back and setting a new all-time high. But we remain neutral for the QQQs with the Elder's Impulse system. When we look at momentum, the PPO is still above its moving average and starting to turn back up. So that is positive for the NASDAQ 100. We're setting another new all-time high. When we look at this chart, the small caps, yeah, they're starting to break out, showing a lot of improvement. Another day or two, and we could see a golden cross here, but we haven't quite seen that yet. And we're above this resistance level, which if we come back down would now act as support, but we're still extreme positive with the RSI. When we look at the Russell 2000 small caps, we're getting close to what could be a golden cross here with the trend, but on a momentum basis, we continue to be positive. And we switched over to positive with the Elder's Impulse system for the small caps. The mid caps have actually generated a golden cross now. So we're seeing that, and we're seeing more strength in the mid caps right now. But we still remain neutral according to the Elder's Impulse system for the mid caps. The financial sector was up again and is in a pretty solid uptrend after spending a lot of 2023 really being under pressure. And the micro caps are also breaking out. We're up into the 117 range. The FANG index has not set a new all-time high yet, but is still looking quite positive. And we're continuing to see if we can go and even break further above this. If we start to fall, we'll be watching some of these areas to see if they provide support. The dollar was down a little bit, even though it's still in a longer term uptrend. Shorter term, it has been under some pressure, and that's been giving support to stocks. Keeping an eye on bonds, where we were down slightly with the 10-year yield, we were up slightly based on price. And I've added this to the list at the end because we're seeing this 1 month to 3 month yield remain positive for quite some time. And that's not normal. That's not what we should see, especially for an extended period of time. And so I'm not really sure what this means, but it is something that's out of the ordinary. An update of our possible positive scenarios. This is the growth to value studies where the QQQs are showing a little bit of improvement compared to the S&P. Discretionary actually is coming back down to the moving average compared to the S&P. And we're seeing where large cap growth is underperforming large cap value. And this is one of our warning signs. If the smart money was really in buying a lot of large cap stocks, we would see this really going up. And that's just not happening. When we look at our other growth to value ratios, showing some weakness with the large caps, we're holding up and actually looking positive with the mid caps, seeing a little bit of an improvement with the small caps. And we continue to be camped out with our 10-day average of the S&P 500 highs minus the lows. We've been here for a few weeks now. And when we look at the broad market, we continue to go up above zero. When we take a 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE, our 50-period new highs, new lows study for the S&P continues to advance. That's longer-term positive. And we're starting to get extreme when we look at the S&P with our 50-period moving average study. Also with the mid caps, we're getting extreme, and the small caps are getting extreme. And now we were only extreme positive based on price. Now we're looking extreme positive based on volume when we look at the 19-day exponential moving average of the advanced decline ratio. We are continuing to go up with the S&P to utilities ratio, and that's giving support to the S&P. And we're continuing to decline with the 2-year yield, which is also giving support to the S&P 500. And we're continuing to decline here with our Staples to S&P 500 ratio, which also is giving support to the S&P. So what's our outlook for Wednesday? We are in holiday mode. Volume is really dropping off. We're wondering, look, so far we have a good start to the Santa Claus rally. It doesn't mean that every day is going to be up. It just means, what does this period of time mean by the time we get finished with it? And then, are we still experiencing the January effect? So far, yes. Is that going to continue? We'll deal with earnings as they are released. Our technicals are still positive, but we are quite overbought right now. We won't have any economic reports on Wednesday, and then we're keeping an eye on all the different geopolitical events. On Thursday, we're going to be getting weekly jobless claims as usual, and the other big one will be pending home sales. And then on Friday, we're going to get the Chicago PMI. Not huge employment reports this week, but still, we want to pay attention to these. Seasonality for December 27th, we're neutral to negative with the Dow and the NASDAQ, where we're neutral to positive with the S&P. And we're wondering if the January effect is still going to continue. That's what this seasonal chart is trying to measure. We do see a little bit of positive action during a pre-election year on the 27th, which will be the 18th trading day of the month. The Carson research has us coming down just a little bit, but then bouncing up after that when we get to the 27th of the month. Wednesday tends to be the most negative day of the week in 2023. But when we look at our seasonal charts, we're still looking pretty good with this chart. Also positive with this seasonal chart, this other seasonal chart, the Carson chart, and the equity clock. I have trouble saying that for some reason. The equity clock chart. But this has us having a little bit of weakness right near the end of the year. But when we look at the Stock Traders Almanac statistics, the NASDAQ is looking positive seasonally, as is the S&P 500. This is another chart. We're wondering if things are going to play out in a similar fashion, where we're comparing the last part of 2023 to 1982. Then we saw a nice little bounce, and that's what we've been seeing. Is that going to be what continues going forward? And then this is another new chart, and this is actually looking ahead into 2024, where it's election year seasonality, where often what we see is the first quarter of the new year, which will be an election year in 2024, we tend to see more sideways. Oops, I should be showing the light, actually the dark blue line. This tends to see more sideways action. Then later on in the year is when we tend to see more positive seasonality. So the scenario's not going with the down one yet, unless you are super duper aggressive with that, because we are overbought. We do want to be aware that if we see some selling and it really starts to pick up steam, that could drive prices lower pretty significantly. But for right now, there's really not a lot of conviction behind any selling. So if anything, we're going with the up scenario, even though we are extremely overbought. And we're still concerned about our sideways analysis, because we're really extreme with the short and intermediate term ADX charts. So the warning signs, we're still really concerned about growth, not participating in this move up that we've been seeing. And that is a concern. The transports also, they have not confirmed the breakout in the Dow, and that is also a concern. The Russell and the small caps, they still have negative trends, but another day or two, and if they can stay positive, and they're quite far above the moving averages right now, we could see golden crosses with those indexes. And then I added the 1 to 3 month short-term bond spread. It continues to be positive. Usually this is something that we see, it comes and then it goes, and we don't see it anymore. It's been going on for a few weeks now. The positive signs, we have quite a list here. The daily special K chart. The equity put call studies that we do are still going down, and that is positive. The risk on posture is showing more improvement. Our oscillators are positive, but they're looking pretty extreme. The parabolic SAR and the vortex indicators, those are both positive. The bullish percent index is extreme. The Kopic curve is positive. The Zohorchak method had switched from being negative back up to neutral. The mid caps have now generated a golden cross. Small and mid cap growth is still positive, but for the most part, it's chopping sideways, with the mid cap showing a little bit of a breakout there. The financial sector is positive, and our new high, new low study, it continues to be positive for the S&P. So our conclusion, we're still positive but overbought right now. In the short term and intermediate term, we are well overextended to the upside. We're also looking overbought in the long term, but for right now, things still remain positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.